Have you ever wondered why the interest rate on your savings account changes, or why the cost of borrowing money for a car or a home can fluctuate so much? It is like a financial weather forecast, always shifting. The interest rates you see everywhere are influenced by several key factors, including central bank policy, inflation, economic growth, and the basic principles of supply and demand for credit. These elements work together to shape the financial landscape for savers and borrowers. Let us dive a bit deeper into why these factors are so powerful. At the heart of it all is the central bank of a country, like the Federal Reserve in the United States. They set a target interest rate, often called the federal funds rate, which is the rate banks charge each other for overnight lending. When the central bank raises this rate, it becomes more expensive for banks to borrow money, and they pass those higher costs on to you in the form of higher rates for loans and often better rates for savings accounts. Conversely, lowering this rate makes money cheaper for banks, which typically leads to lower rates for consumers. Inflation also plays a huge role. Imagine lending someone $10 today, but when they pay you back in a year, those $10 can only buy what $8 could buy today. That is inflation at work. Lenders need to ensure that the interest they earn compensates them for the loss of purchasing power due to rising prices. So, if inflation is expected to be high, interest rates will generally rise to protect the lender's real return. Economic growth also acts as a strong current. When the economy is growing robustly, businesses want to expand, and consumers want to spend, leading to a higher demand for loans. This increased demand for money tends to push interest rates up. On the other hand, during slower economic times or recessions, demand for loans falls, and interest rates usually drop as lenders compete for fewer borrowers. It is a classic case of supply and demand for available money. So, how can you use this information? By understanding these influences, you can anticipate potential rate changes and make informed decisions. For instance, if you expect rates to rise due to central bank actions or increasing inflation, it might be a good time to lock in a fixed-rate loan. If rates are expected to fall, you might consider a variable rate option or delay a large purchase. One insider detail is that longer-term interest rates, like those on a 30-year mortgage, often reflected the market's expectation of future inflation and central bank policy over that entire period. This is why you sometimes see bond yields, which are effectively long-term interest rates, moving in anticipation of economic news. The difference between short-term and long-term rates, known as the yield curve, is a powerful economic indicator. Ultimately, understanding the forces that influence interest rates empowers you to navigate your personal finances with greater confidence. It helps you see beyond just the number and grasp the bigger economic picture, allowing you to choose the best time to save, borrow, or invest, ensuring your money works smarter for you.